What if I told you that right now, there are legal credit score tricks that banks quietly benefit from you not knowing? And some of them could shift your financial life completely within the next 30 days. Not next year. Not after years of building history. 30 days. Stay with me because by the end of this video, you are going to walk away with a completely different understanding of how credit actually works, what levers you can pull to boost your score fast, and some tax advantages hiding in plain sight that most people completely overlook. And if you are new here and you want more content that actually explains the financial system in a way that works for real people, hit that subscribe button right now. We are building a community of people who refuse to stay financially confused, and you should be part of it. Let us start with something that happens to people every single month and drives them absolutely crazy. You pull out your credit card, you make a significant purchase, maybe new appliances, a flight, some furniture. You have the money sitting in your bank account. You are not worried. You are responsible. You wait for your bill, and the second it arrives, you pay the entire thing off. Zero interest, zero late fees. You did everything perfectly. Then 3 days later, your phone buzzes. Your credit score just dropped 20 or 30 points. And you are sitting there thinking, what on earth just happened? This experience is more common than most people realize, and it reveals something important about how the credit reporting system actually functions. Most of us are taught that the due date is the only date that matters. Pay by the due date, avoid interest, avoid penalties, life is good. But there is another date on the calendar that is arguably more important when it comes to your credit score, and almost nobody talks about it. That date is your statement closing date, and understanding it changes everything. Here is how the system actually works. Your credit card has a billing cycle, usually about 30 days. During that cycle, you swipe your card for groceries, gas, subscriptions, whatever. Your balance climbs throughout the month. At the end of that billing cycle, the bank closes the statement. They generate your bill. And here's the critical piece of information that banks are not exactly rushing to explain to you. The balance printed on that statement is the number that gets sent to the major credit bureaus: Equifax, Experian, and TransUnion. That number gets locked into your credit report for the month. Your due date typically comes about 25 days after your statement closes. So you might have racked up a balance of $3,000 by the time your cycle ends. That number flies off to the credit bureaus, and then a few weeks later you pay the whole thing off. The bureau never sees the payoff. They already took their snapshot. They recorded $3,000, and if your credit limit is $5,000, that is 60% utilization, which the scoring algorithm treats as a serious red flag, even though you are literally sitting there with zero debt the day you pay it. This is the concept that changes the game when you understand it fully. The credit scoring system does not watch you in real time. It works off of snapshots, and the snapshot is taken on your statement closing date, not your due date. If you are not controlling when that picture is taken, you are letting the bank determine your creditworthiness based on the highest point of your spending cycle rather than your actual financial habits. So what is the solution? You need to pay your balance down before the statement closes, not before the due date. Before the statement closing date. If your billing cycle ends on the 15th of the month, you want to log into your account around the 12th or 13th and manually pay down your balance. When the 15th arrives and the bank generates your statement, it will show a low balance, and that low number is what gets reported to the bureaus. You end up with excellent utilization on your credit report, even though you spent freely during the month. Then your due date arrives a few weeks later, and you pay off whatever tiny amount remains. Simple, powerful, and completely within the rules. Now you might be wondering why this matters so much. It matters because credit utilization, which is simply how much of your available credit you are actually using, makes up 30% of your FICO score. Think about that for a second. Nearly 1/3 of your entire credit score is determined by a single number that resets every single month. It outweighs how long you have had your accounts open. It outweighs your mix of credit types. The only thing that beats it in the scoring formula is payment history at 35%. So if you are ignoring utilization, you are ignoring almost 1/3 of your financial reputation, and the thresholds matter enormously. Staying below 30% utilization is generally considered good. Staying below 10% is where the really strong scores live. People with scores in the 800 range tend to report average utilization somewhere between 4 and 7%. Not 0, not 50. A small, controlled, intentional number. The sweet spot is not being absent from the system. It is showing up and demonstrating that you handle credit responsibly. Here is another thing that surprises people. Reporting a 0 balance on every single card every single month is not actually optimal for your score. When every card shows a 0 balance all the time, the algorithm has no data to work with. It cannot evaluate how you manage repayment because it looks like you are not using your credit at all. The system is designed to reward people who use credit wisely, and complete inactivity can make you look like an unknown quantity rather than a reliable borrower. A strategy that higher score achievers often use involves paying all their cards to 0 before the statement date, except one. On that one remaining card, they leave a tiny balance, maybe 1 or 2% of the limit, just enough to signal active use. A $10 reported balance on a card with a $1,000 limit is showing 1% utilization and tells the algorithm that yes, this person uses credit and handles it responsibly. That is the behavior the system rewards. And here's the important clarification. Reporting a small balance does not mean paying interest. As long as you pay that reported balance before your due date, you owe absolutely nothing in interest. You are using the gap between the closing date and the due date strategically. Now, here is a warning about something that can get your account shut down if you are not careful. Some people hear about paying down balances before the statement closes and decide they can game the system by spending their entire limit, paying it off, spending it again, and paying it off again, multiple times within a single billing period. This is called credit cycling, and banks treat it as a serious red flag. When you cycle through your full credit limit several times in 1 month, their risk systems flag it as potential fraud or money laundering. Your account can be frozen, reviewed, or closed entirely. The statement date strategy is not about cycling credit. It is simply about making one deliberate payment before the closing date to control what balance gets reported. Keep your spending within your normal monthly limit, and you have nothing to worry about. One more practical tip before we move into the tax side of things. If you are thinking about closing old credit cards to simplify your wallet, please reconsider. When you close a card, you eliminate that card's credit limit from your total available credit. Your balances stay the same, but your available credit shrinks, which automatically increases your utilization percentage. An old card with a $10,000 limit and a 0 balance is actually doing enormous work for your utilization ratio, even while it sits untouched in a drawer. Put a small recurring subscription on it, set up autopay, and let it quietly anchor your numbers. Now, let us shift gears and talk about something that does not get nearly enough attention in everyday conversations. Tax advantages that are completely legal, available to ordinary people, and almost never discussed in plain language. First, if you work from home in any capacity and you are self-employed, freelancing, or running any kind of side business, your home office can be a legitimate deduction. The IRS has 2 methods for calculating this. The simplified method lets you deduct $5 per square foot of your dedicated workspace up to 300 square feet. The regular method calculates the actual percentage of your home used exclusively for business and applies that percentage to your housing costs, including rent or mortgage interest, utilities, and insurance. Neither of these is a secret. Both are written into the tax code, but millions of people with legitimate home office situations never claim them because nobody sat them down and explained it clearly. Second, if you are carrying student loans, the interest you pay on those loans may be deductible up to $2,500 per year, depending on your income level. This does not require itemizing your deductions. It is what is called an above-the-line deduction, meaning it reduces your adjusted gross income directly. People pay thousands in student loan interest annually and never realize part of it can come back to them at tax time. Third, contributions to a health savings account are one of the most underutilized tax tools available. If you are enrolled in a high-deductible health plan, you can contribute money to an HSA and get a tax deduction on those contributions. The money grows tax-free, and if you use it for qualified medical expenses, you pay zero tax when you take it out. That is a triple tax advantage that most investment accounts cannot come close to matching. Unused balances roll over year after year and can even be invested in market funds within the account for long-term growth. Fourth, the Earned Income Tax Credit is one of the most significant credits available to working individuals and families with lower to moderate income. Yet it goes unclaimed by millions of eligible people every single year. The IRS itself has acknowledged that a meaningful portion of people who qualify for this credit simply do not claim it, often because they did not know they were eligible or they filed incorrectly. If your income falls within certain ranges, this credit can put hundreds or even thousands of dollars directly back into your pocket. It is worth checking your eligibility every single year without assuming that previous years are a reliable indicator. Fifth, if you are paying for childcare so that you or your spouse can work or look for work, the Child Independent Care Credit allows you to claim a percentage of those expenses. This applies to daycare, after-school programs, and similar arrangements. It often gets overshadowed by conversations about child tax credits, but it is a separate and stackable benefit that families regularly leave on the table. Sixth, and this one catches people off guard, if you are contributing to a retirement account and your income is below a certain threshold, you may qualify for the Saver's Credit. This is a credit, not just a deduction, which means it reduces your actual tax bill dollar for dollar, rather than simply reducing the income that is taxed. It rewards lower and moderate income earners for saving for retirement and stacks on top of any deduction you already receive from contributing to a traditional IRA or 401k. The common thread running through all of these is that the tax code is not designed to exclusively benefit wealthy people with expensive accountants, even though that is sometimes how it feels. Many of these advantages were written specifically for working and middle-class people. The issue is accessibility. The language is dense. The rules have caveats. Most people do not have the time to wade through IRS documentation, so they never claim what they are legally owed. This is why financial literacy is not just a nice thing to have. It is a measurable difference in your actual net worth over time. Understanding how your credit score is calculated and taking control of when your data gets reported can mean qualifying for lower interest rates on a mortgage or auto loan, potentially saving tens of thousands of dollars over the life of a loan. Understanding your tax advantages can mean reclaiming hundreds or thousands of dollars annually that you were already entitled to. The financial system is not designed to explain itself to you. Banks profit when you carry high balances unknowingly. The gap between a reported balance and an actual payoff date is not a mistake in the system. It is a feature that works against you if you do not know it exists. Credit bureaus receive the information they receive and build scores from it. They are not your financial advisor. Nobody in that chain has an incentive to sit you down and explain the statement closing date. That is exactly why content like this exists and why the conversation matters. The information we covered today, the statement closing date strategy, the utilization sweet spot, the all zero except one method, the home office deduction, the HSA triple tax advantage, the Saver's Credit, these are not classified secrets. They are available to anyone willing to look. But most people never look because nobody hands them a clear starting point. So here is your action plan from today. Find your statement closing dates for every credit card you own. They are usually buried in your billing cycle information or on a past statement, PDF. Mark them in your calendar. The week before each closing date, log in and check your balance. Pay it down to below 10% of your limit. Or if you want to optimize aggressively, pay it down to around 1% and leave a tiny nominal amount on one card. Then let the statement close, confirm what was reported, and pay off the remainder before your due date. Do this for 60 days and watch what happens to your score. On the tax side, if any of the credits or deductions mentioned today are new to you, bring them up with a tax professional or do your own research using the IRS website directly. You have nothing to lose by checking your eligibility and potentially hundreds or thousands of dollars to gain. The game is absolutely winnable. You just need to know the rules that were not printed on the welcome letter when you opened your first account. Come back and drop a comment telling me which part of today's video hit hardest for you. And share this with someone who would benefit from knowing this information. I will see you in the next one.